Hello and welcome to Pro Trader Strategies Market Commentary for Friday, January the 19th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data, albeit there's not a whole lot to talk about on the economic data front. Across the pond, Great Britain, we got retail sales month over month came in at negative 1.5%, expected to be a negative 0.8%. Pretty lackluster at best there, and they revised last month's number down from 1.1% to 1%. So a slight revision there, not looking too good on that retail sales number for Great Britain. I would expect to have seen that a little bit better, especially around that holiday season. Anyway. We got University of Michigan consumer sentiment here in the United States came in at 94.4, down from the 97, and then they revised that last month's number down from 96.8 to 95.9. So even consumer sentiment starting to wane a little bit right now. And then the inflation expectations in line with expectations at 2.8%. One other thing we had Quarles speaking earlier or later have Quarles speaking right now, and we had Bostic speaking earlier this morning during all that economic data. All right, on to the overall markets. We've got, as you can see, I fixed my Fibonacci levels finally, put those onto the 5-year Fibonacci levels, but left my trend line in there. We've gone back down into this trend channel that I've set up, and it's been working that way for basically half of the year for the most part. That trend still intact. I think we're going to continue to see that move higher. People talking about having OPEC cut production or increase production now that we're starting to see oil move higher. This is exactly what they want, you guys. They do not want oil in the 60s. They would much rather have it up in the 80s. That might be where they consider talking about increasing production, but before that, I don't see it happening. I'm not even too concerned, really, because we have as much oil as OPEC, albeit ours is more difficult to get out, but right here at these levels, we can start pumping it out like there's no tomorrow. So oil, I don't really see going much higher than this. I think it might trend a little bit, but I don't see it really going up into the hundreds anytime soon, which is kind of where my Fibonacci levels are based on. Onto gold futures. Moving a little bit higher today. We were seeing the VIX spike as well as the equities were kind of losing a little bit of steam. They're kind of rebounding a little bit now, which is, part of the reason why gold's giving up a little bit of ground here as well. We're also seeing Bitcoin down, which could cause upward pressure in gold as well. But we have gold futures up about $6 on the day, staying above that Fibonacci level there. And this is what I was talking about with Bitcoin being down. It's not down a couple of thousand points, but it is down on the day after yesterday's nice rebound that we saw. It looked like it was getting pretty ugly, but it did have a rebound late in the day yesterday. Giving up some of those gains, though, now. Then on to the bonds. Bonds looking like they're trying to make a little bit of a bottom here, and I wouldn't be surprised to see a little bit more of a bounce here, back up to test this value area high before we continue on down to test this 145 handle. So could see a little bit of a pause here, maybe a bounce. Right now, it's pretty undescript. We're going to really need to wait and see on Monday, see where these really kind of line up, and really for that matter, the rest of the day. But it could be looking like it's finding a little bit of support. I think people are getting a little bit weary up at these levels. Yesterday we talked about this trading up, or 2 days ago, trading up to try and test the 13 handle. Traded higher yesterday again with the VIX. Today giving up a little bit of ground as the market started turning around. We're starting to see a lot of VIX volatility come out, but at the end of the day, it's still staying at pretty heightened levels with us trading at pretty close to historical highs anyway. Here's the Dow Jones Industrial Average. It's down on the day, as you can see. at the, not quite the lows of the day, but pretty close to it, while the NASDAQ is actually pushing higher. We're seeing the NASDAQ up 18 points, had a new all-time historical high intraday, so that's important to note. That did happen during the day session, so that is a solid number. This, it's hard to say right now. Are we creating a flag to the spike to the upside, or is it going to snap back down? That's yet to be seen, obviously, right now, but it is consolidating. It's that winding of the rubber band that I talk about. Anytime you get these moves, you start winding that rubber band. It's going to snap in one direction or the other. We don't necessarily know at this point, but right now we just know that that rubber band is getting wound a little bit tighter in the NASDAQ. The S&Ps, the Dow, all of those are starting to wind that rubber band up. When we start seeing these tighter and tighter markets, that is indication that there is a move ready to happen, or it's building pressure in a sense. This is the 30-minute chart of the E-mini S&Ps, each one of these candles representing 30 minutes on the day. And as you can see, it's not necessarily an inside day, but it feels like it as we're trading right within yesterday's range. For the most part, it has broken out to the upside there, but it still feels like an inside day to me anyway. As the market's really kind of tightening up going into this weekend. People are settling up their positions despite the fact that we haven't really gone anywhere. On to a few trades that I'm looking at right now. UPS, obviously, I still have this thorn in my side with UPS. Now, what I have on right now is I'm short in my IRA. I have a short call spread, but it's built out like a synthetic call spread in a sense, where I'm short the January that expired today. I'm short the 132 puts in there, if I remember correctly. I know I am. I don't know why I'm double checking everything, but I'm short the January 132 puts in there. And in my IRA, I did it as a put spread, and in my margin account, I just did it as naked puts. So with my IRA, I'm going to leave on. I have the 132 calls that I'm short. Those are in the money right now. And then the 140 calls that I'm long to define that risk. Basically, I was able to buy those for a nickel. I'm going to leave those. I'm not going to pay to get out of that trade. I'm just going to let it ride. But as I've done with like AIG and a couple other ones, Verizon, just left those on rather than pay the commissions to get out. Crazier things have happened, right? So that's why I'm leaving those on. But I am trying to get out of the January 132 calls that I'm short in both my IRA and in my margin account. And right now, I'm trying to get out for like 41 cents. Way away from the market right now. I think it's trading around 70 something. I needed to go down there and test that 132 handle. I was able to get out for a scratch. I was trying to work it at 141. It got down to about 148. I might have been able to get out, which would have been a scratch in both my IRA and my margin. But I was squeezing it out, and then as you can see, I rode it out a little too long. It snapped up and hasn't gotten back down there yet. So watching this on a 15-minute chart today, looking for any kind of breakdown to that 132 handle. I'm going to look to get out for a scratch if I get that opportunity again. And if it starts to rally, I'm going to pull the ripcord on it as well. So keeping a real close eye on UPS. It's the chart I'm going to be basically having up all day today. IBM, I went in there and sold some puts yesterday. I talked about it in the daily market commentary. That's what I was going to look to do, is play this to the upside. I think that they're moving to the cloud is a good choice, getting away from the service high margin or low margin, high labor intensive aspect of their business, getting into the cloud, ramping up for cryptocurrency when it goes to the cloud. I've been talking about all of these levers and pulleys for some time now, like trying to short NVIDIA, remember? Trying to short NVIDIA because I think that they're going to be getting away from those graphic cards when they move to the cloud and all of these things. And I may be a little bit early, obviously, with IBM. They did talk about it in their earnings call about looking into blockchain. IBM, for some reason, people don't want to be getting into cryptocurrencies, blockchain, things of that nature. That's what they're talking about. They're the only stock that really hasn't been rallying on that kind of information. And I thought that that might be the time where people started realizing, hey, this is a good opportunity for them. Came out with better than expected earnings. A lot of people talked about that bad earnings slide only coming to a halt first time in 22 earnings calls or something like that that they beat. Well, they beat because of the tax cuts in a sense. So a lot of people poo-pooing that and not really getting grasp of them taking over on cryptocurrencies and stuff like that and being that cloud service for them. Who would you trust? Amazon with your cloud service or IBM when you're doing these cryptocurrencies? I would lean towards IBM myself. There are other marketing aspects to getting in bed with Amazon. You know, they could get Amazon to start accepting Bitcoin earlier for some of those products. But right now, I think that the way to go would be IBM, but that's my personal opinion. Anyway, in those IBM January, I sold the 160 puts in there for 60 cents. Obviously, I got tested on the overnight session when it kind of slammed down there. I was a little bit nervous, was not looking very good. But like I said, I try to cover these in the first 15 minutes before it makes any crazy moves. And I was able to get out of this for 7 cents on that little pop right off the open. So as soon as it went out of the money, or it was out of the money anyway, but it started rallying. Those puts basically were worthless, got out of that, and luckily so, because it did nothing but move to the downside in the next few hours. So out of that for a nice little trade, helped take some of the sting out of it, a couple of these other losers that I had. So that's a good thing for that anyway, and hopefully we can get this UPS to come off just a little bit more, and we'll be able to get out of those for a scratch. And the only thing I really have to kick myself for is that Gilead trade, which still hasn't turned around. So I'm glad I got out of that one. All right, that's all I got for you guys today. Today's webinar is going to be on the short put spread. So if we're playing stuff to the upside, this is a great opportunity, especially with high volatility that we saw in like the VIX. Those volatility spikes in the VIX is the time where we want to be getting into these trades where we can sell some premium, because as you see, the volatility comes out rather quickly. We can get out of those trades, kind of like with IBM. I was directionally wrong here with IBM, you guys. Directionally wrong, like way wrong on this trade. But that volatility crush, getting in when there's high volatility, those premiums come out, I ended up being a nice winner on that trade, despite the fact that I completely blew the directional assumption on it. So that's why we follow these rules. Stay mechanical. Know when to get in, know when to get out. All right? So follow me on Twitter and check out that webinar today at 2 o'clock Mountain Time, 4 o'clock Eastern. All right? Can't take that? Take it easy.